In the world of corporate finance, bankruptcy is a public spectacle, a definitive moment when a judge bangs a gavel, creditors rush to salvage assets, and the doors are padlocked shut. But for a sovereign empire, bankruptcy looks entirely different. It is not a singular event of liquidation, but a slow, silent process of suffocation, where the value of the currency is meticulously destroyed to save the institutions that issued it. If any publicly traded company operated with the balance sheet of the United States government, possessing over $35 trillion in hard debt and $175 trillion in unfunded liabilities, while burning cash at a rate that eclipses its revenue by nearly double, its executives would be indicted for fraud and its assets seized within days. Yet, in the halls of Washington and the boardrooms of Wall Street, this mathematical insolvency is not treated as a crisis, but as a permanent state of affairs concealed under layers of complex accounting and the terrifying privilege of the printing press. The secret bankruptcy is not a conspiracy theory found in the dark corners of the internet. It is a verifiable economic reality found in the Treasury's own ledger, a reality that suggests the United States has arguably been insolvent since it severed the final link to gold in 1971, surviving only by systematically defaulting on its citizens through the invisible tax of inflation. To understand the gravity of this situation, one must look past the political theater of debt-ceiling debates and focus on the cold, hard arithmetic of fiscal dominance. We have now crossed a threshold that economic historians have long identified as the point of no return, the moment when a nation spends more on servicing its past debts than it does on its national defense. As of this year, the interest payments on the U.S. national debt have surpassed the budget of the Department of Defense. This is the financial equivalent of a household spending more on credit card interest than on rent and food combined. When a government reaches this stage, it loses its agency. It can no longer make decisions based on strategy or public welfare, but is forced to make every decision based on the desperate need to keep the bond market from collapsing. The stakes are existential, not just for the American portfolio, but for the global order, because the U.S. Treasury bond is the collateral upon which the entire world's financial system is built. If the collateral is worthless, the system is a hallucination. This state of affairs did not happen by accident, nor was it the result of a single administration's incompetence. It is the culmination of a century-long strategy to detach the concept of money from the constraints of reality. To trace the origins of this secret bankruptcy, we must rewind to the spring of 1933, in the depths of the Great Depression. Newly inaugurated, President Franklin D. Roosevelt faced a banking system in freefall. The promise of the United States government to redeem its paper currency for gold coin was being tested, and the government was failing the test. The gold reserves were draining, and under the strict laws of the time, the government could not print more money without holding more gold. The solvency of the state was on the line. On April 5, 1933, Roosevelt issued Executive Order 6102, a decree that remains one of the most draconian seizures of wealth in American history. It essentially criminalized the possession of monetary gold by any American citizen, forcing them to turn their savings over to the Federal Reserve in exchange for paper currency at a rate of 20.67 per ounce. Once the gold was secured in government vaults, Roosevelt devalued the dollar, raising the price of gold to $35 an ounce. Overnight, the government had created profit on its balance sheet by robbing the purchasing power of its own people. This was the first soft default. It was a bankruptcy proceeding where the creditors, the citizens, were forced to take a haircut so the debtor, the government, could stay in business. It established a dangerous precedent. When the math doesn't work, the government changes the value of the numbers. The narrative deepens as we move to the post-war era, specifically the Bretton Woods Conference of 1944. Here, the United States, emerging as the sole industrial victor of World War II, established the dollar as the world reserve currency, backed by gold. It was a system of trust, predicated on the idea that the U.S. would not print more dollars than it had gold to redeem, but the temptation of empire was too great. Throughout the 1960s, the guns and butter policies of the Johnson administration, fighting the Vietnam War while expanding the Great Society welfare state, required more capital than taxes could provide. The printing presses ran hot, flooding the world with paper claims on American gold. By 1971, the French and the British saw the insolvency on the horizon. They began repatriating their gold, sending battleships to New York Harbor to exchange their paper dollars for physical bullion. The run on the American bank had begun. On August 15, 1971, President Richard Nixon appeared on television and temporarily suspended the convertibility of the dollar into gold. This was the second bankruptcy, a total default on the international obligations of the United States. In that moment, the dollar ceased to be a store of value and became a tool of geopolitical force. The Nixon shock was not a policy tweak. It was the admission that the United States could not pay its bills in real assets. From that day forward, the U.S. government was technically bankrupt, operating entirely on the confidence of the world that it could continue to refinance its debt forever. The mechanism that has allowed this zombie system to shamble on for another 50 years is the petrodollar system. In 1974, recognizing that a currency backed by nothing would soon be worthless, the U.S. struck a strategic deal with Saudi Arabia. The U.S. guaranteed the military security of the House of Saud, and in exchange, the Saudis agreed to price all oil sales exclusively in U.S. dollars. This created a synthetic demand for the currency. If a nation wanted energy, it had to acquire dollars first. This recycled the world's trade surplus back into U.S. Treasury bonds, allowing the American government to run deficits that would have destroyed any other nation. It was a brilliant, albeit parasitic cycle. The U.S. exported inflation to the world in exchange for real goods and resources. However, the mechanism relies on one critical variable: low interest rates. For the last 40 years, a secular decline in interest rates allowed the government to service its growing debt cheaply. This was the eras of the Great Moderation. But the mechanism has now broken. The inflationary spike of the 2020s forced the Federal Reserve to raise rates, exposing the rot at the core of the sovereign balance sheet. Today, the United States is borrowing money simply to pay the interest on the money it borrowed yesterday. This is the definition of a Ponzi scheme. When a private citizen does this, it is financial ruin. When a government does it, it is called quantitative easing. The difference is that the government controls the denominator, the currency itself. This brings us to the parallel with the decline of the French monarchy in the late 18th century. In the decades leading up to the French Revolution, the French crown was functionally bankrupt, burdened by the debts of past wars, including the American Revolution, and an opulent court. They attempted to solve this solvency crisis through financial engineering, utilizing the theories of John Law to introduce paper currency and speculative bubbles. They masked the deficit with new loans and creative accounting, assuring the public that the state was sound. But the laws of mathematics are immune to royal decree. The interest payments eventually consumed the entire budget, forcing the king to call the Estates General to raise taxes, which triggered the political collapse. The United States today is in the late stages of this same cycle. We see the same denial from the elite, the same reliance on financial complexity to hide simple insolvency, and the same widening gap between the official narrative of recovery and the lived reality of economic stagnation. The hidden forces maintaining this illusion are the primary dealers and the central banking network. We must look at the repo market, the plumbing of the financial system, where banks lend to each other overnight using treasuries as collateral. In September 2019, months before the pandemic, this market seized up. Rates spiked to 10% overnight because the banks realized the collateral, the U.S. government debt, was becoming too abundant and too risky. The Federal Reserve had to step in and print hundreds of billions of dollars to lubricate the gears. This was the silent cardiac arrest of the financial system. It revealed that there is no real market demand for U.S. debt at these levels. There is only the artificial demand created by the Federal Reserve and regulated institutions forced to hold it. The power structure is effectively a closed loop where the government issues debt and its own central bank buys it, pretending a market transaction has occurred. As we enter the acceleration phase, the data becomes terrifying. The debt-to-GDP ratio is over 120%, a level where historical analysis shows economic growth becomes permanently stunted. But the acceleration is not just linear, it is exponential. The compounding of interest is now working against the taxpayer. In the next decade, the Congressional Budget Office projects that the U.S. will add $20 trillion to the debt, assuming no recessions and no wars, an assumption that borders on delusion. We are seeing the debasement cycle accelerate as countries like China and Russia dump their treasury holdings, sensing the insolvency. This forces the Fed to become the buyer of last resort, which requires more money printing, which causes more inflation, which drives yields higher, which bankrupts the government further. It is a doom loop from which there is no dignified exit. The climax of this narrative forces us to confront the big truth that no politician will utter on a debate stage. The United States government has absolutely no intention of paying back its debt. To believe otherwise is to ignore the basic laws of mathematics. To pay off $35 trillion in debt plus $175 trillion in unfunded liabilities would require a taxation rate of nearly 100% on every American citizen for generations, or a slashing of government spending so severe it would eliminate the military, Social Security, and Medicare overnight. Neither of these is political suicide. They are political impossibilities. Therefore, there is only one door left open, the same door chosen by every bankrupt empire from Rome to Weimar Germany. They will inflate the debt away. This is the secret bankruptcy. It is not a formal declaration where the Treasury defaults on a bond payment. Instead, it is a soft default executed through a policy known as financial repression. The goal is to keep interest rates lower than the rate of inflation. If inflation is 8% and the interest on the debt is 4%, the real value of the debt decreases by 4% every year. It sounds like a clever magic trick, but there is a catch. The wealth that extinguishes the government's debt must come from somewhere. It comes from you. Every percent of inflation is a direct tax on your savings, your wages, and your pension. The government is effectively transferring the solvency of the American household to the balance sheet of the American state. They are bailing out the Titanic by siphoning the water into the lifeboats. The revelation is that the money you work for is no longer a store of value. It is a claim on government credit that is being actively diluted to prevent a sovereign default. The price of the stock market hitting all-time highs is not a reflection of economic health. It is a reflection of currency devaluation. We are witnessing a crack-up boom, a phenomenon described by Austrian economist Ludwig von Mises, where asset prices skyrocket, not because companies are more productive, but because the currency is dying. The system is designed to sacrifice the currency to save the bond market. The bankruptcy has already happened. We are simply living through the liquidation phase, where the purchasing power of the middle class is liquidated to settle the accounts of the state. As the dust settles on this analysis, we are left not with a conspiracy, but with a ledger. The secret bankruptcy of the United States is the defining economic reality of our time, the gravitational force that explains the chaos in our markets, the polarization in our politics, and the anxiety in our homes. It is the end of the exorbitant privilege that allowed America to live beyond its means for half a century. But history reminds us that while systems fail, civilizations adapt. The end of the paper dollar standard is not the end of the world. It is a transition to a new equilibrium, one that will likely be anchored in hard assets, decentralized finance, and a return to tangible value. For the individual, the time for complacency is over. The strategy of passive faith in the government, its ability to manage the economy, is a losing bet. The state has signaled its survival strategy. It will print, it will debase, and it will seize purchasing power through inflation. The antidote to this bankruptcy is not fear, but education and preparation. It is understanding that in a world of infinite liquidity, scarcity is the only truth. It is realizing that you cannot rely on a bankrupt counterparty to secure your future. The United States will remain a powerful nation, just as Britain remained after the pound sterling lost its crown. But the era of the magic money tree, the era where debt didn't matter and deficits didn't have consequences, is officially closed. The bill has arrived. The bankruptcy is no longer a secret to those who know how to read the balance sheet. The only question remaining is not if the default will happen, but how much of your own sovereignty you will retain when the restructuring is complete. If the secret bankruptcy is the problem, then we must critically examine the solution being prepared behind the curtain. The state cannot simply default and walk away. It needs a mechanism to manage the collapse without losing control. This brings us to the final and perhaps most dystopian chapter of this narrative: the transition to central bank digital currencies, CBDCs. This is not merely an upgrade to the technology of money. It is a fundamental rewriting of the relationship between the citizen and the state. In a traditional bankruptcy, assets are liquidated. In a sovereign bankruptcy managed through digital currency, freedom is liquidated. The debt is so large that it can only be managed by programmable money. This allows the Federal Reserve to implement policies that are currently impossible. Imagine a scenario where the economy is slowing down, but instead of lowering interest rates, the Fed simply puts an expiration date on your digital dollars. You must spend them within 30 days, or they vanish. This forces velocity of money, artificially stimulating the economy while stripping you of the ability to save. This is the ultimate tool against a bankruptcy. If you can control how and when people spend, you can engineer artificial demand to soak up the excess debt. We are already seeing the architecture for this being laid. The Project Cedar by the New York Fed and the Regulated Liability Network are not hypothetical experiments. They are beta tests for the post-dollar era. The bankruptcy of the old system is the pretext for the introduction of the new one. They will sell it as convenience, safety, and financial inclusion. But in reality, it is a digital enclosure, a fenced pasture where every transaction is monitored, approved, or denied based on the algorithm of the state. It is the perfect solution for a bankrupt government. If you can't pay your debts, you simply change the rules of the ledger so that no one can exit the system. However, history shows that whenever a state attempts to totally capture the economic life of its people, a parallel system emerges. This is the gray market, the agora, or the counter-economy. In the Soviet Union, it was the Blatt system of favors and trading. In Zimbabwe, it was the use of US dollars and hard assets. In the impending American transition, we are likely to see a bifurcation of the economy into two distinct spheres: the compliance economy and the sovereign economy. The compliance economy will be easy, digital, and state-sponsored. It will be where you pay your taxes, receive your universal basic income, a likely necessity as the middle class evaporates, and buy consumer staples. But it will be a cage of negative real rates and surveillance. The sovereign economy will be where real wealth is stored. This will be built on assets that have no counterparty risk: physical gold, silver, land, and decentralized, censorship-resistant digital assets like Bitcoin. These are the exit doors from the burning theater. The elite have already engaged in this diversification. They are buying farmland, art, and precious metals, assets that cannot be inflated away or turned off with a switch. The ultimate act of rebellion in a bankrupt empire is not to fight the state in the streets, but to exit its ledger. It is to build resilience that does not depend on the full faith and credit of an insolvent institution. The secret bankruptcy is a trap, but it is a trap that only works if you remain entirely dependent on the bait. As we move forward into this volatile decade, the most valuable asset on your balance sheet will not be dollars, but autonomy. The system is resetting. Make sure you are the one holding the pen when your personal contract is rewritten. The final reckoning of this secret bankruptcy is not just economic, it is a reckoning of trust. For nearly a century, the American public has operated under the assumption that their government is a benevolent steward of the economy. The revelation of insolvency shatters this illusion. It forces a painful psychological break. When you realize the money in your bank account is simply a liability of a bankrupt state, and that the state is actively diluting that liability to survive, the relationship between citizen and government changes forever. We are moving toward a period of financial Darwinism. Those who understand the game, who understand that debt is a weapon, that inflation is a tax, and that the official numbers are a veneer, will adapt. They will move their labor and capital into hard assets. They will minimize their exposure to the dollar. They will build networks of trust outside the banking system. Those who do not, who continue to trust the headlines and save in fiat currency, will be the fuel that keeps the engine running a little longer. They will be the ones who pay the price for the government's insolvency. This is the end of the free lunch. The laws of economics, suspended for so long by the exorbitant privilege of the dollar, are reasserting themselves. The bill has come due. The secret is out. And now the only question that matters is, what will you do with this knowledge? Will you continue to play by the rules of a broken game, or will you prepare for the new reality that is already taking shape beneath your feet? The bankruptcy of the United States government is a historical fact in motion. The future belongs to those who see it coming.